Good morning, everyone. I want to welcome you to our webinar on the Consolidated Appropriations Act. As Ben and I were putting this together, I was having a little bit of deja vu, feeling like it was 9 months ago, because we did some similar webinars back in April of 2000. Not long after the pandemic, we started to feel the effects of the pandemic, and of course, 9 months later, unfortunately, we're still feeling some of those effects, which is unfortunate. But the fortunate side is that we, after a bit of a wait, we have some additional funding and mechanisms that can help support a lot of companies who are hurting throughout this entire ordeal. So we want to go through that with you today. I wish everyone a happy new year, and thank you for attending. So I'm gonna kind of run through what we're gonna go over today. I'm Dan Massey. I'm a partner with Walls Group. Ben Rittenauer will also be presenting. He's a senior manager. We're both in the assurance department of the firm, and glad to be presenting to you today. So big picture outline of what we're looking at. We're going to talk about taxability of PPP. I know that's a big deal for a lot of people who got funds the initial round of Paycheck Protection Program. We're going to talk about the second round of PPP. So we're going to refer to things as PPP1, which would have been the first round. We're going to talk about PPP2, which is the second round. We're going to talk about forgiveness of PPP1 and PPP2. Some simplifications there to the forgiveness process for certain loan recipients. Talk a little bit about SBA loan, other SBA loans outside of the PPP program. We'll touch upon the Shuttered Venues Operators Grant, as well as the FFCRA, which was a separate law that came out around the same time as the CARES Act. A big component of this is going to be the employee retention credit. There's impacts here to the employee retention credit in 2020 and 2021. So while there's a number of items on this outline, the big things that we're going to touch upon, the meat of this, is going to be PPP1 and PPP2 and the employee retention credit. So we tried to split those up a little bit so that we can maintain your attention throughout the period. We're looking at then we're going to finish up with some miscellaneous items and some tax matters. We're looking at probably an hour and 15 minutes of content here, and then we'll have a 15-minute session for Q&A. If you have questions, there is a Q&A tab at the bottom of, or depending on how your screen is set up, on your webinar Zoom. So if you have a question, feel free to type something into there. At the end, we will address those questions and to the best of our ability. If we don't get to your question live today, we will email you directly with an answer to your question. A couple other things just about today here. This is being recorded, and we will have it up on our YouTube channel, and we'll have a link to it. So if you'd like a copy of the video after this, you'll have access to that. We will also send out the slides here from the PowerPoint subsequent to the completion of the webinar today. Okay, so a couple caveats here before we go into things. The SBA is providing further guidance, and I don't know what time it was last night, but I think it was probably after I was in bed, and there were some interim final rulings that came out late last night by the Treasury. There's two interim final rulings. One is 82 pages and one is 42 pages. So unfortunately, we have not been able to digest that 124 pages of interim final rulings, but I suspect it's probably what we're going to be doing this afternoon. So we're going to give you what we know at this point. We're not going to go into every conceivable scenario. If you have specific questions about your situation, we do want to answer those. So we're going to give you our contact information at the end of this. We'll be glad to have a conversation with you about the applicability, strategy, those sorts of things. So don't hesitate to reach out, but today it's going to be somewhat broad and based on what we know. There's a couple areas that are going to need additional clarification, specifically the shuttered venue operator grant and the employee retention credits. So we're going to tell you what we know about those, but just high-level caveat going into those, there's probably a little bit more uncertainty about some aspects of those two areas than perhaps some others. So just by way of a brief bit of history here, this law was passed by Congress in the third week of December. The text of the act became available on 12/21. Then 6 days later, on 12/27, the president signed it into law. There's roughly 20 acts that are all combined into here, and it's 5,000 pages long because it included information on government funding and keeping the government in operation. So for the most part, the things that are going to be impactful to you are just two areas, Division N and Division EE. So if you happen to find the 5,000-page text, you can do a Control F find for those two areas, so you don't have to read through 5,000 pages of government appropriations. We're going to refer to this act as the Consolidated Appropriations Act, or the CAA. So if we reference that, we're talking about in general this law. So at this point, I'm going to turn it over to Ben. I'll be back a little later to discuss a few other things, but for right now, I'm gonna kick it over to Ben.
Thank you, Dan. Appreciate the introduction. Thank you, as Dan alluded to, for everybody in attendance. Glad you're here. Hopefully you can find this time to be beneficial. As Dan alluded to, please do ask questions, whether through the question and answer or emailing us afterwards. One, we want to make sure we get your questions answered, but two, there's a reality that for the best way for us to really dive into this and get our heads around it and know how to apply it to you is by knowing your specific circumstances and how we can answer those. So please do ask questions. We welcome them. That's not an empty request. So just a little history. One of the biggest items, it's a very simple item when it comes down to it, but one of the biggest hot topics waiting for a bill to be passed, hoping that a bill would be passed, was whether or not that bill would address taxability of PPP proceeds. If you go back to the CARES Act, which we received in late March, the CARES Act said it was non-taxable and that the funds would be non-taxable. And there was, I can remember the questions, are you sure it's non-taxable? This seems too good to be true that they're going to give me money and I don't have to pay taxes on it. But that's what the bill said. And that's the understanding we went with for about a month until on April the 30th, the IRS put out a revenue ruling that says that's all well and good. The CARES Act says it's non-taxable, but you can't deduct the expenses attributable to non-taxable income, and therefore it essentially became taxable. And from April 30th until December 27, when the CAA was signed, we were operating under the umbrella that they were taxable, but there was the hope that it would be addressed in a bill. But that hope started in July when discussions around the second bill started, and it got more and more antsy as we got closer and closer to the election, and it continued to be uncertain as we got through the election. But thankfully we did get a bill signed. The bill did address the taxability issue, and the bill made very clear that no deduction should be denied related to PPP forgiveness and also EIDL advances. And if you have been having SBA loan payments made on your behalf through subsidies, those are non-taxable as well. So it addressed that very clearly. Now, to be honest with you, even on December 27, when we got this bill, there was still in the back of your mind, but what if the IRS comes out with some other way to say, nope, that's nice that that's what they wanted to do, but we're going to reverse it. Thankfully, yesterday, the IRS put out a revenue ruling that coincides with the bill. And there was, at least from my part, there was a big exhale of, okay, I can't conceive of any scenario where we're potentially going to have to backtrack on this. It feels very clear now that for federal purposes, at least, these will be non-taxable to you if you receive PPP1 funds. And as many of you have been tax planning, that is a big deal. That is a big deal for all of you. I will note that for Pennsylvania purposes, and obviously I'm just going to talk about Pennsylvania here real quick. If you were in multiple states, not every state is necessarily going to coincide with the federal application of this. For Pennsylvania, if you are a C Corp as it sits now, it would be non-taxable to you. If you are a flow-through entity or a sole proprietor, as it sits here today, for Pennsylvania income tax purposes, it would be taxable. And if your Pennsylvania income is flowing to Lancaster, it would presumably be taxable there as well. So there may be some tax owed on this at a state level, but from a federal level, it should be non-taxable. And that's a huge relief. If anything, if nothing came out of this bill other than the taxability, it would have been a win. But thankfully, there's some other things covered. As Dan alluded to, we're going to spend a little bit of time still talking about PPP1 because the new bill did make some changes and modifications to that. All favorable, really, when it comes down to it. It's not like they look to pull the reins in. They did make some liberalization of it or clarified some things. And they have said that if these liberalizations allow you to increase the amount you can borrow, you can go back and increase your PPP1 loan. Now, before we get to the next slide that has the details, we don't believe most of this is going to be worth the while to do. We think that the impacts are fairly minimal for the vast majority of people that it would apply to. But we also felt that withholding the information wasn't doing you justice. So wanted to have it here. So there are some new expenses that are eligible to increase your loan and are eligible for forgiveness if your PPP1 loan has not yet been forgiven. So I'll start out this discussion with saying if you have a PPP1 loan, you have already applied for forgiveness and received forgiveness, you are not allowed to go back and increase your PPP1 loan. Items that were added were group life and disability insurance, vision, or dental. For many people, it was there was an understanding that vision and dental were allowed to begin with, and they probably were already on many PPP1 loans in their calculations. The group life and disability are new, but keep it in mind that the calculation is 2.5 months out of the year's worth, so essentially just 21% of the cost. We think that's probably not going to be worth pursuing in most instances. If you're a single member Schedule F farmer, there's some clarification there that could allow you to get some more funds. So if you fall under that umbrella, please do reach out to us if you haven't gotten PPP1 forgiveness. We are still waiting on the mechanism of how they're going to do this. Some considerations could be if you get additional funds, does that restart your PPP1 covered period and cause you to have to wait another extended period of time before you can apply for forgiveness? Are there new loan documents, or are they just going to amend existing ones? Those are some of the questions out there that we make us feel like this is not a slam dunk, but it is a reality out there. So those are new eligible expenses that can increase your loan, increase your forgiveness. There were also additional expenses added to allowable forgivable items. These won't increase your loan, but if you are in a scenario where you are short on your spend for PPP1 full forgiveness, these could help you get over that hurdle and get to full forgiveness. Many of you are already in the scenario of full forgiveness without it, and the value there isn't quite as significant, although I will touch on a point at the bottom here that it may be valuable to you. But if you are not at full forgiveness, and you still have 60% of payroll, and you're just looking for additional expenses to try to get you to full forgiveness, these may come in hand. There's 4 buckets. I'm not going to read these 4 bullet points. As Dan said, we'll send you this slide deck afterwards and you'll have them. But I'll give you a quick summary on them. Operation expenditures, it's a pretty broad topic, but largely in my mind, it's your computer software for your business. And it's not that these had to be entered into to address COVID. It's not like you had to get cloud computing to be able to work from home, and they're saying that's a forgivable item. This is pretty much any of your business system software. Property damage costs, if you had property damage related to vandalism due to public disturbances, those can be picked up. Supplier costs, this is a big one. We think, I'd like to break this down. There's a 1 and a 2 there, and I think it makes sense to break this down into 2 topics. One is perishable goods and one is non-perishable goods. So the first one, let's talk about non-perishable goods. So let's say you had, I don't know, wood comes to my mind. So let's say maybe you're a builder and you bought a significant amount of lumber, and you placed that order before you got your PPP loan, and you had to pay for it after you got your PPP-1 loan. That would be eligible for forgiveness now. So that's perishable goods. It's you have to have the order in place before your PPP-1 loan in order for perishable goods, or non-perishable goods. I apologize, I'm talking non-perishable here. You had to have the order in place before PPP-1 for non-perishable goods to be eligible for forgiveness. On the flip side, if you are dealing in a world where you have a lot of perishable goods, restaurants come to mind here. Any perishable good cost you incurred during your covered period is now eligible for forgiveness. So if you're a restaurant not at full forgiveness, under the realms and the guidance of the 60-40 rule, this could be a big deal for you, because that could be a significant portion of your food cost falls under a perishable good umbrella. So that's a big one, why I wanted to spend a couple minutes there. Worker protection, this is broadly retrofit items. What comes to my mind is the plexiglass. If you had to install plexiglass or anything, any other costs incurred to minimize the spread of COVID, that would be eligible for forgiveness as well. Be careful. Another thing that comes to mind on retrofit is if you received a Lancaster recovery grant. If you'll remember, one of the eligible expenses for a Lancaster recovery grant was retrofit items. And I encourage you to be careful that if you got a Lancaster recovery grant, that the CAA Act does not say, hey, you can't use these funds for if you got Lancaster recovery grant funds. But Lancaster recovery money for sure said that you weren't allowed to double dip with PPP, and that presumably still applies. So the other item to consider here is that due to changes made to the employee retention credit, which Dan's going to cover in details earlier, there is now the potential for you to be incentivized to minimize the amount of payroll used on your PPP-1 forgiveness app. So there has been a thought process along the line with PPP-1 forgiveness to maximize the amount of payroll on that application. And the reason is multifold. One, for simplicity. If all you have to do, if you can get to full forgiveness with payroll, why take the time to gather up all the documentation for non-payroll? From a potential for the bank to ask questions or the SBA to ask questions, if you're only giving them one piece of information to ask questions on, the amount of questions they can ask is less than if they have 4 pieces of information to potentially question. But with that said, due to payroll potentially being eligible for the employee retention credit, there may be reasons to not want to maximize payroll and to try to get as close to 60% payroll as you can. So Dan will get into that in more detail, but wanted to touch on it here as we talk about these additional expenses and why they might be applicable to you. So now let's go to PPP-2 and talk about PPP-2 a little bit. The reality is, in my mind, everything before this is kind of the headliners. And as we get into PPP-2 and into the ERC, we start getting into kind of the main acts and what you're probably here for. The nice thing is that at least coming into today, I thought the PPP-2 wasn't super complicated, especially in light of what we know from PPP-1. As Dan alluded to, we did get a 42-page IFR last night that makes me rethink that thought process. But presumably it's pretty straightforward. And I'll just go down through these bullet points because they kind of are the nuts and the bolts of it. The first one, you have to have less than 300 employees to be eligible for PPP-2. Presumably this is based on headcount. That's what PPP-1 was predicated based off of. So we're presuming that same thought process will apply here. If you have multi-locations or are part of an affiliated group, There are specific rules for that, so let us know if you have specific questions about 300 employees. If you are easily under 300 employees, you don't have an affiliated group, then then it's easy, you're under and you're good. But if you're in a scenario where in one scenario you're under 300 and in another scenario you're over 300, let's work through that with you and see where you end up. Second bullet point, in order to be eligible for PPP2, you must have a 25% quarter over quarter gross receipts reduction as it relates to 2020 to 2019. So if your first quarter 2020 is more than 25% down from first quarter 2019, you're eligible. If your second quarter 2020 is down more than 20% from second quarter 2019, you're eligible, and so on for third and fourth quarter. As we came into this, one of the questions was, how do you measure gross receipts? How is gross receipts defined? Taking a quick glance at what got issued last night, it appears that they're relying heavily on how you reported on your tax return, to the extent that if you're a business that doesn't have great records, they're even going to look at your 2019 and 2020 tax return as a potential criteria for determining your eligibility. So presumably whatever method you are using to calculate revenue on your tax return is how this will be measured. We'll be, as Dan alluded to, we're going to dive into that. I believe this gets clarified in more detail and we'll get you that information. But as I sit here now, I think it's safe for you to assume that that is based off of your tax return method. And if you think that you're in the ballpark of that 25%, we recommend you starting to dig into that. Another point of clarification, an item we had some questions come through on earlier, was whether PPP1 proceeds count towards gross receipts. And our answer up until today was we don't think so. But again, looking at it really quickly here, it looks like they for sure say no, PPP1 funds do not count towards gross receipts. So if you're sitting there thinking, do I need to factor in my PPP1 money to gross receipts? The answer, I believe, is no. Now to get into kind of the nuts and bolts. So if you have less than 300 employees and in any quarter in 2020 compared to 2019, you had a more than 25% reduction in revenue, presumably you check those boxes and you can move forward to a calculation. So the calculation is very, very similar to PPP1, whereas you take 2.5 months of payroll costs, and that payroll cost will be either 2019 or 2020 full year payroll costs. Keeping in mind that for PPP1, it was either a rolling 2.5 months of a rolling 12 payroll or 2.5 months of a calendar year 2019. So many of you probably already used calendar year 2019 for calculating your PPP1 payroll costs. And if your 2019 payroll is more than your 2020 payroll, you'll likely have the same dollar amount of PPP2 loan as your PPP1 loan. So if you get through the first two bullet points and say, yep, I think I'm eligible, start gathering revenue data, and second, start gathering payroll data for 2019 and 2020 to determine how much your loan can be. One of the nice additions to PPP2, if you have an NAICS code beginning in 72, which my guess is most of you don't have your NAICS code memorized, maybe you do, but 72 is largely accommodations and food service. If you have an NAICS code of 72, you are allowed to use a multiplier of 3.5 instead of 2.5. And while that may not seem like a big difference, practically it's a 40% increase. It's a 1 over 2.5, which is 40% increase over the 2.5 months. So if you're an NAICS code 72 and you received a PPP1 loan, it's reasonable to expect that your PPP2 loan could be 40% more at a minimum. So that is nice. Maximum loan is 2 million. PPP1, the maximum was 10 million. So the maximum loan amount has come down. We are hopeful that given some of the criteria above and the maximum loan of 2 million, that the funds won't be as quick to run out in PPP2 as in PPP1. Time will tell, but that is our hope. And from a forgiveness side, similar to PPP1, you still must be at least 60% payroll costs. You can't go less than 60% payroll cost in your forgiveness calculation when you get to that point. Now, another eligibility piece, similar to PPP1, is that certifications must be made. And the certifications are similar to PPP1. The one bullet point that the uncertainty of current economic conditions makes necessary the loan request to support the ongoing operations of the eligible recipient. That should sound familiar. It is essentially what you had to sign off on PPP1. And we think that that is going to, again, be a critical component that the applicant will have to sign off on. Keeping in mind that we expect for PPP2 loan recipients to be published again, we somewhat expect there could be a higher level of public scrutiny on PPP2-1 than there was in PPP2. And this is purely subjective, just kind of a thought process, but acknowledging the fact that in April there was tremendous uncertainty in front of us. We hadn't been through 9 months of a pandemic at that stage. At this stage, we have been through 9 months of a pandemic, and presumably some level of uncertainty may have gone away. Some of it may not. But we ask you to keep in mind, and encourage you to keep in mind, I guess is a better way to put it, that we think that the bar to get over that uncertainty level may be higher now than it was with PPP1. First, due to the 9 months of experience you have since PPP1, and also acknowledging that your name will be listed probably in the paper again saying you got PPP2 money. And if people know your business, that could raise some questions. Another criteria, and we don't think this is going to be applicable to most of you, but worth noting, is that you have to have used or will use all PPP1 funds. So if you have used all your PPP1 funds, that's very easy to determine. I used them all. I've got a full forgiveness application already prepared. Easy. Will use all your PPP1 funds. They really don't say how you determine that you will use all your PPP1 funds. Presumably, you're going to have to certify that you will use them all. But if you're at a place where you're not at full forgiveness with PPP1, you'll probably have to be thinking through, okay, how will I be able to prove that I will be using them all? And we're expecting additional detail, acknowledging we got some last night. We think there'll be more to come. And just please bear with us as we learn through this process. PPP1 was a learning process where you thought you had something nailed down, and then you woke up the next morning and something got posted where you realized, nope, we didn't have that nailed down. They went different than us. So please do bear with us as we work through the ups and downs with this. Now for just a couple small things before I hand the ball back over to Dan to cover ERC. The first is that with the CAA Act, one of the things they added was that they simplified the forgiveness application for loans under $150,000. It's not automatic forgiveness. There was some rumblings that they may do automatic forgiveness underneath a certain threshold. They did not do that. You still need to complete an application. It thankfully is simpler. The biggest benefit, I think, in my mind, as we look through it, because you still have to do the calculation to be able to substantiate that you're at full forgiveness, or you're at the forgiveness level you're requesting, is that you don't necessarily have to submit the documentation. And practically speaking, one of the most challenging parts of the forgiveness application has been submitting the information in a manner that the banks can use. At no fault of their own, they have a level of excellence that they have to meet. But there is a challenge to getting all the information into the bank portals at times. And if the reality is that we no longer have to do that, we think there's a benefit to just kind of taking a wait and see approach to see how this under $150,000 application rolls through if you fall in that umbrella. More details to come. At this stage, no bank has updated their portal that we're aware of to factor this in, but we expect that will be coming down the pike. The last thing to cover before I hand the ball back to Dan is SBA loan. If you are one of those businesses that is receiving a subsidy for your SBA loan payments, if you're having this done for you, you know you're having it done for you. If you're sitting here saying, Ben, I have no idea what you're talking about, then the reality is that this doesn't apply to you. But if you're sitting there saying, oh yeah, I'm one of those people that I haven't had to make a payment on my SBA loan for the last 6 months, this relates to you. And what the CAA says is that that's going to continue. It's based off of different circumstances in determining how much longer, but it'll either be for an additional 3, 6, or 8 months. So if you've been getting that benefit, that will continue here into 2021. If you'd like to nail down exactly what that is, you can let us know, or if you have a contact at the SBA, they may be able to walk you through that as well. But you should be able to see it continue for a period of time here going forward. So with that, Dan, back to you.
Okay, thanks, Ben. So first thing we're going to get into here is the Shuttered Venue Operator Grant, which I may abbreviate as SVOG. This was something that we were anticipating coming out, being a portion of this act. There was the Save Our Stages Act had been, rumbling around Congress, but didn't get passed until it became part of this act. And I know we've got a number of clients that are in the live event industry, entertainment industry, so recognize that this is a sensitive topic for a number of people that are on this webinar here today. There's about 30 pages of this bill that were appropriated for the Shuttered Venue Operator Grant, and about $15 billion is allocated for it. When we first, I know, I'm not speaking for Ben too much, but when he and I kind of had similar thoughts, we first read this and we're like, oh, thank goodness, there's information in here for the live event industry. And then as we read it closer, it looked like, depending on the definition, this may be focused narrower than we had hoped, or perhaps maybe than you had hoped if it applies to you. So there's a couple different ways to interpret this realistically. I mean, a very conservative interpretation means that we're just talking about the venue operators, the arenas, the stadiums, the playhouses. Museums can actually come into play here if they have an amphitheater or a stage or something like that. That's the conservative reading of it. A more liberal reading of it could include people who service those industries that are supporting services. Realistically, some of these things are legal matters that honestly we're probably not quite prepared to give a judgment on. If you think that this may apply, it probably would not hurt to talk with your attorney about it to see if you apply. Now, that's assuming that we don't get additional IFRs or FAQs about who could potentially fall under the category of being able to apply for this. The other thing about the Shuttered Venue Operator Grant, there is specific scrutiny that's been identified within the Act about this. So there's supposed to be an audit plan that's presented within 45 days, and then that gets updated every 30 days or something like that thereafter. So they do have a plan for scrutinizing this, probably more so than we've seen in other aspects of the CARES Act or the CAA. There is the representation again about the uncertainty of economic conditions. For the most part, that certification is not going to be as hard to meet for members of this industry than perhaps members of a different industry, back to what Ben had said about that certification under PPP 2. The amounts here, the lesser of 45% of 2019 gross revenue or $10 million. So if you have $22 or more million of revenue in 2019, you're looking at a $10 million grant. And should be noted here, this is a grant, not a loan. This is a grant. So the nice thing about the SVOG is you can cover costs for a period of 20 months, which is quite a bit of time there. Now we also have on here, unspent funds within 1 year of the grant must be returned. Maybe when they were writing this, they had better hopes for how quickly this would roll out. Obviously, at this point, since there's not a mechanism for actually getting these grants yet, and we're already into 2021, 1 year from the grant date is going to go past 12/31/21. So those dates, those 20 months from the beginning of March 2020 to the end of December 2021 are going to be your eligible spending periods, and your eligible expenses are going to be similar to PPP 1. So, by and large, 45% of your revenue covering 20 months, covering almost 200% of a year, 183% of a year. Ideally, you'd be able to get, to be able to cover most of those expenses. There's some question here. The biggest questions we have about this, other than who is applicable for the grant, who's eligible for the grant, is the interplay between PPP 1 and PPP 2. And the law doesn't delineate between PPP 1 and PPP 2, but it does kind of talk about things in a forward-looking manner as opposed to a retroactive look. So I think a pretty consistent interpretation of this from what we've read is that if you get the SVOG, you cannot apply for a PPP 2 loan. However, it is possible that it also precludes you from applying for this if you got a PPP 1 grant or loan. We don't know the answer to that yet. Additionally, there's no language in the bill that talks about double dipping expenses between PPP 1 and the sheltered venue operator grant. So if you got a PPP 1 grant and you used those funds from, say, April to September, now you get a sheltered venue operator grant, and it covers that period that you used PPP 1. It doesn't say anything about not double dipping those expenses. One would think that you can't double dip those expenses, but there's not been any guidance that we've seen on that. So the fact that they were silent to that may be a reason that to believe that PPP 1 and shuttered venue are mutually exclusive and you can't do both. But we don't know that answer yet, and hopefully that'll be coming out. I've not read the IFR today to see if they address the shuttered venue operator grant at all, but hopefully we'll have something about that. We are pretty certain that PPP 2 and shuttered venue, you can't do both of those. PPP 1 still kind of up in the air. Okay, the FFCRA, if you're involved in human resources or you have a human resources person, they're probably very up to speed on this. Deals with sick time related to either employees who have COVID or caring for someone who has COVID, looking after a child whose school closed or daycare closed or whatever because of COVID. And then there's a credit that comes through and you can apply for on your payroll tax returns. I think we have not been getting too many questions about FFCRA. I think most people know how to apply it at this point. The big part of this law was that initially this was to expire on 12/31. It will now expire on 3/30/21. So an extra 3 months that you can use FFCRA, the stipulations of the FFCRA. So that's the big takeaway there. Okay, now we're going to get into the ERC. And just starting to look at the Q&A, one of the very first questions before we even got into things was about the ERC. So I know that this is a topic that a lot of people have interest in. So there's two components here that we're going to talk about. There's ERC 2020 and there's ERC 2021. We're actually going to spend a lot of time on ERC 2020, which seems a little odd considering we're already in 2021. But that's where there's really some opportunity for some strategy, some maneuverability, and so we're going to talk about ERC 2020 for quite a bit. We're also going to talk about 2021. Now, unlike the CARES Act, where it's kind of two separate tranches, and they talk about it within the act as the original PPP and then second draw PPP, ERC is basically just one credit, but there are different rules in 2020 and 2021. So bear with us as we go through. There's a lot of information here. And again, different rules for 2020 than there is for 2021. So we're going to go through a lot here. If you have questions, we'll try to address them here at the end. But if you have questions specific to your business, again, I can't overemphasize that we want to talk with you about this and see how it can impact you. So, in the initial CARES Act, you read you see that there's an employee retention credit in there, and it's credit for 50% of wages up to $10,000 in wages per employee that you can get. And when we first read the CARES Act, we're like, wow, this is great. Basically $5,000 per employee that you're going to get as a credit. I mean, you've got 100 employees, that's a $500,000 credit. That's significant. And then, you know, and at that point when the CARES Act first came out, basically you had to be subject to a shutdown order, which at that point there was a lot of, especially in Pennsylvania, Lancaster County, a lot of businesses were subject to a shutdown order. Even those that, you know, come May, June, July were no longer shut down. Late March, April were shut down. So it also indicated that you had to have a reduction in revenue. That later got clarified to be a 50% reduction in revenue as a subsequent FAQ. We'll talk about that in just a moment. But anyway, so initially there was a thought about how the ERC could really benefit a lot of people. Then you see there's kind of a corollary down near the end of the CARES Act that says if you got PPP funds, you can't get ERC funds as well. So that basically led most companies to a position where they didn't apply for employee retention credit. They didn't claim an employee retention credit on any of their 2020 941 forms. And the 941 would be your payroll tax return where you claim this credit. So we had very few, at least of our clientele, very few people claim an ERC in 2020 in either the first, second, or third quarter because they were all getting PPP funds. So that was the initial ruling. Now, we're going to tell you basically what we think is the intent of the law, but as we said at the caveats at the beginning, there is some uncertainty about this. We're hoping for clarification. I did a brief find on the two IFRs that came out for employee retention credit, and there's only like 2 or 3 places where it comes up. It does not look like they went into a ton of detail on the employee retention credit with the IFRs that came out last night. So we're going to tell you what we think the intent is and what is pretty consistent with other interpretations that we've seen from business websites, from the National Law Review. But again, this is subject to interpretation, and there is a little bit of lack of clarity. So, big picture, it looks like now, even if you did get a PPP-1 loan, you can still get an employee retention credit, and that the idea is that as long as you're not double dipping those wages, you can't have a specific, let's say Joe Schmo got paid $1,000 on April 2nd, let's say April 20th. If that was covered by your PPP-1, you can't also apply that to your employee retention credit. So it seems like as long as you're not double dipping those wages, that you can apply for an employee retention credit even if you've applied, even if you got PPP-1 funds. So that's really important. So let's talk a little bit about eligibility here. I referenced this a little bit, but before we get into all these things, let's talk about eligibility before we go into all of the ramifications of this, because if you're not eligible, then it doesn't really matter. So the eligibility here, very important. We've underlined it twice. It's the only thing that's underlined on this sheet at all, is the word or. So this is not, you don't have to meet both of these qualifications. You can meet either one of them. And this is looking at on a quarter-by-quarter basis, calendar quarter. Your business is shut down by government order. So, that would be any sort of government authority. Generally speaking, as the state of Pennsylvania. Now, they had different rules county by county, but there was state order about gatherings or, and then there was the whole thing about, are you a life-sustaining business? Are you not? If you remember back 9 months ago, 10 months ago. We had all that discussion. So if your business was shut down by government order, then you can apply for the employee retention credit. Now, the part where you would be eligible for the employee retention credit only covers the period where you were shut down. So if you were shut down from, say, March 15th to April 15th, you can't claim all of your wages for the first and second quarter, even though you had wages in the first quarter and second quarter that would apply. So it's just for the period that you were shut down. We think that there's probably a large portion of people that are going to have some applicability here, because this starts on March 12th, and most people didn't get their PPP funds until, potentially the earliest really we saw was like April 7th, 8th, but a lot of times it was mid-April where people were getting funds. So you do have a 3 or 4 week period in there where you are not covered by PPP. Now, maybe you used an alternative payroll covered period for PPP, where you kind of went back and looked at wages paid, like the moment that you, right a couple days after you got PPP, which would cover wages earned back into that period. So depending on your situation, maybe those wages earned in the latter half of March were covered by PPP, but if they weren't, then most places are probably going to have some potential here for claiming this credit. But again, most places it's probably just going to be a short time frame depending on how long you were shut down. Of course, restaurants and some other places were just subject to a somewhat of a shutdown order here at the end of December, as well as at least in terms of like indoor dining and things like that. So could that be considered a partial shutdown? I think you can make that argument. So that's the first item. The second item is the drop in year-over-year gross receipts, which is really quarter versus quarter. So if you compare your 2020 revenue in any quarter and compare it to the same quarter in 2019, if you had a 50% decrease, then you're eligible for the employee retention credit for that quarter. So that's pretty. If you had revenue of $2 million in the second quarter of 2020, and you had $5 million in that same quarter in 2019, well, that's a 60% drop, so you would be eligible. So that's a nice bright line test. And the way that we are reading this is that this is based on what would go onto your tax return taxable income sort of thing. So, and then there's a kind of a corollary here that says you can once you hit that 50% threshold, you can continue going until your gross receipts for a quarter are up to 80% of what they were for that same quarter in 2019. So we're going to get into a couple examples that'll go through that on the next slide. So just hold that thought for a second. But if you had for this component, the drop in gross receipts, you're eligible for all wages paid during that quarter, assuming they weren't covered by PPP. And as Ben had indicated before, if you got a Lancaster recovery grant as well, you need to be cognizant of the wording in there, because again, I think the intent of that grant was that you don't want to be double dipping into things that are funded by other sources. So just have that in the back of your mind as well. Okay, so let's go over a couple examples of what things might look like in terms of your gross receipt drop. Example 1, your first quarter of 2020, your gross receipts were 40% of 2019. Then in the second quarter, it went down to 30%. The third quarter, you recovered, you're at 85% of 2019. The fourth quarter was 75% of 2019 for the same quarter. You can claim the employee retention credit for quarter 1. And now you're going to see, again, this is only for March 12th onward, but you could claim the credit for quarter 1 because you were below 50%. You can claim it for quarter 2 because you were below 50%. And then what the way it reads is you can continue to do that until you get to a point where you were where your gross receipts were more than 80%. And so until the end of that quarter, basically. So the third quarter here, even though we're above 80%, you kind of get grandfathered into that quarter by the fact that it's the first quarter you've had over 80%. So you would be eligible here for the third quarter. Now let's look at the second example. First quarter, you're at 60%. Second quarter, you're down to 30%. Third quarter, 75. Fourth quarter, 85. So first quarter, not applicable. You're over 50%. Second quarter, you're under 50%. So now you kind of start the clock rolling with being applicable for being eligible for the credit. The third quarter, you're at 75%. That's over 50, but you haven't hit that magical 80% threshold that stops your clock ticking. So the clock continues to run here until you get to a quarter that you're over 80% till the end of that quarter. So the third quarter, I haven't hit that threshold yet. So I'm going to apply for the third quarter for sure, and I'm going to apply for the fourth quarter as well. Now, at the end of the fourth quarter, then we'll get into 2021, but I've hit that threshold, but I'm good to the end of Q4 of 2020. So that's important to look at. If you don't have any quarters below 50%, well, then it's a pretty easy situation. But if you only have one quarter that's below 50%, it doesn't mean that that could be the only quarter that you could apply for if you haven't gotten above 80%. In fact, if you have anyone below 50%, you're almost guaranteed that quarter and the subsequent quarter. So for a lot of people, Q2 is going to be the quarter to focus on because that was in the height of shutdowns and shelter-in-place orders and all those sorts of things. So I know most companies had a pretty significant drop in April. If it took some time to kind of come out of that, then your second quarter, there's a good chance that that's a 50% reduction from 2019, which automatically puts you in the second and third quarter role there. So just be cognizant of what quarters you could potentially apply for. I think a good thing to do, and just kind of looking forward, is when we're done here, if you haven't already done it, I would compare, and you should be able to get this data out of your accounting system pretty easily. I just take your first quarter, run a P&L quarter by quarter, compare 2020 to 2019, and look to see what your revenue changes are to see which quarters are potentially applicable. So one thing that's not entirely clear here is what happens if you, like in our example 1 there, we were below the threshold. Quarter 3, we went above the threshold. What if in quarter 4 you went back below the threshold? Could you be eligible then in quarter 4? Does the clock start ticking again or not? I tend to think it would, but I don't necessarily know. So anyway, that's kind of to be determined. If that's your situation, I still think that's a unlikely situation if you went below 50 to above 80, back to below 50, but it could happen. So if that's you, you're probably in the minority of cases, but let's talk about it. Okay, so moving on with more ERC 2020. Now we've talked about if you're eligible or not, we can talk a little bit more about how to go about addressing this. So, like I said a couple times here, we're looking at any wages between March 12th and December 31st that, again, were not paid with forgiven PPP funds. So one of the things that's a little unclear here is, and it's going to make a really, really, really big difference, is what if you have a 24-week covered period, but you used all your payroll within 12 weeks? And that's not an uncommon scenario. We've had a lot of applications that we've looked at where people have said, well, I've used my funds within 12 weeks. I'm just going to give them the information for that period, and that's been fine. Are the wages that you're only putting on your application, are those the ones that you can't double dip with, or is it everything within that covered period? I think a reasonable explanation would be the former, where you're just saying, well, these are the ones I got forgiven on. This is what I used the funds for. Yeah, I had other payroll in this period, but I'd already used all my PPP funds, so the forgiveness of those funds didn't go towards this payroll in the second half of the covered period because I'd already used the funds. I think that's a very reasonable approach to take. However, it's not completely certain. So Ben had mentioned, so we'd like to see that clarified, but so again, we can prepare, we can plan, but some of these things we might need to get a little bit of clarification on before we can feel 100% confident in what the intent is. So Ben had mentioned before, kind of gave a little prelude to this, that previously we had indicated, for sake of ease, it was going to be a lot easier to have your forgiveness application be payroll expense centric. If you can get everything with payroll, just put your payroll on there, apply, and it'll be easy and we'll be over and done with. Now, there is potentially the incentive to have fewer payroll costs. If 100% of your PPP funds went to payroll, great. But if you can get them down to 60% and have 40% of non-payroll costs, that other 40% of wages that you freed up that aren't being used with PPP funds can now potentially be used with ERC, can be subject to the ERC, which can really be a big number. So that's really what we're looking at here. And for someone like restaurants, for instance, or anyone who has perishable goods, this is a real big deal because that 60-40 threshold, most people were able to meet that without a whole lot of difficulty. When it was 75-25 initially, that was a little harder. 60-40 was easier to meet. But if you've got perishable goods and you're a restaurant and you were purchasing perishable goods for the entirety of your PPP covered period, well, that is a lot of expenses, and you might, if you use all those expenses as forgivable expenses on your PPP application, you can easily get your wages, get your wages down to 60%. And that frees up a lot of wages that you can use for your employee retention credit. So the original ruling, and these numbers are going to change a little bit when we talk about 2021, but for 2020, the threshold was 100 FTEs. So if you had less than 100 FTEs, all the things that I just talked about, no questions asked, you're good. You can go ahead and pending the clarification, of course, but presumably you can go forward with the ERC. If you're over 100 employees, full-time equivalents, you can potentially still apply for this, but it would be in a case where you're paying your employees because you want to keep them on payroll. You don't want to have to go find new employees. You don't want to lay them off and risk them going somewhere else. So you're paying them even though they're not providing services. The IRS has a boatload of FAQs about the employee retention credit. There's almost 100 of them. But a couple of them talk about, well, what does do not provide services mean? So you can be someone that's on salary that is salaried for 40 hours a week, and you're continuing to pay that person, but maybe they're working only for 10 hours a week. Well, the 10 hours that they're working, if you're more than 100 FTEs, would not be eligible for the employee retention credit. But the 30 hours that they're getting paid that they're not providing services would be subject to the employee retention credit. So if you're over 100 FTEs, there's still possibly a way that you can get some credits here for 2020. Your eligible wages include healthcare costs. So kind of similar to PPP, where your payroll number included the cost of healthcare. So again, that's the case for the employee retention credit. Owners and family members of owners are not eligible for this. So if you're an S corp where you're the 100% owner, you're the only employee, say, well, keeping yourself on payroll probably doesn't get you the employee retention credit. So okay, let's continue to move on here. So how do we claim these credits? Now, we talked about how this was 50% up to $10,000. So depending on what quarters you're eligible for, like I said, a lot of people could be subject for quarter one or the beginning of quarter two before they got their PPP. Well, you claim this credit through your 941 and your payroll tax return. So how do you go back and claim it? You presumably, the way to do this is through an amended 941, which would be called a 941X. It's possible it could be simpler than that if we get some additional clarification, but for right now, that's kind of what we're interpreting the most reasonable course of action part of me to be. So that's the first 3 quarters. The fourth quarter creates a little bit of a conundrum potentially, because while the IFRs that we got last night were mostly due to PPP funds, and that's because the law said that the SBA had 7 days from the passage of the law to provide some, or 10 days to provide some clarification. That clarification came out. For the ERC, they have 30 days. So unfortunately, that puts us in a position where, and from what I've heard, I think that's just business days, not calendar days. And if that's the case, it takes us into past the end of January into the beginning of February. So the clarity that we're looking for, the FAQs, the IFRs that are going to come out and give us some more guidance on this, may not be available until after your fourth quarter tax return, payroll tax return is due, because they're due January 31st. So, you might not want to hold up the filing of your return hoping for clarification and then have to scramble to get it filed on the 31st or the couple of days before the 31st. So you may need to file your fourth quarter as normal and then amend that as well. But you may only have, depending on how your employment flows during the course of the year, you may be able to get most of this credit on the fourth quarter and not worry about going back to the first 3 quarters. If you've used your PPP funds, and most people use their PPP funds if they got them in early to mid or even late April, they've used them by late September, early October. So for the most part, most of your fourth quarter wages, if you've meeten the threshold, the 50% threshold or the government shutdown threshold, you're going to be eligible in the fourth quarter. So perhaps, and since you can only use $10,000 of wages per employee for the entire year, if you've been able to hire some people back in the fourth quarter, maybe you look at that and you say, well, I can get $5,000 worth of credit per employee here in the fourth quarter. I'm not going to worry about quarters 1, 2, and 3 because I'm already over the $10,000 per employee wage limit. And when you consider health costs being in there, it could be $8,500 or $9,000 worth of actual wages and $1,000 or $1,500 of payroll costs, or of healthcare costs. So that's something to take into consideration before you go and say, oh my gosh, I'm going to have to amend all of my 941s. You may be able to get the max credit just by looking at the fourth quarter. So again, we expect some clarification on this topic. It has potential to be really significant. A lot of times, tax credits or payroll credits don't seem like they're big dollars. But the example I'd gone for before, if you're 100 employees, or let's just say you're 50 employees, and you've had revenue reductions, but you've kept 50 people on payroll, $5,000 per credit for 50 employees is $250,000. That is significant money. So definitely encourage you to look into whether or not this could be applicable for you, because the dollars can potentially be significant. Additionally, there's no certifications or documentation required to be submitted here. Now, you need to keep your documentation because you could always be subject to an audit or an inquiry or whatever, but there's nothing that needs to be sent in with the 941 form, which makes the ease of applying or claiming the credit high. There's not a whole lot of barrier to entry to claiming this credit. So that's an important thing to know. So that's ERC 2020. Still some things to be clarified, but you can see how this can be big money and how you can kind of go back in time and look at that. So let's talk about ERC 21 now, which the concepts are the same, but some of the thresholds and the numbers are different. So the CAA extended the employee retention credit, which would have ended at the end of the fourth quarter of 20, through the second quarter of 21. So we got 6 more months, 2 more quarters. The credit is now significantly more. Not only does it change from 50% to 70% of eligible wages, it changes from $10,000 annually to $10,000 per quarter. So you used to have the max credit you could get for any one employee was $5,000. Theoretically, the max credit you can get now for any one employee is $14,000, 2 quarters, $10,000 a quarter, times 70%. your eligible quarter threshold has also become easier to hit. Instead of being a 50% reduction, it's now a 20% reduction. So any quarter gross receipts that are less than 80% would be eligible. The important thing to note here is, even though this is 2021, we are looking back to 2019, not to 2020. So ERC 2020, you're looking at the prior year. ERC 21, you're looking at 2 prior years. And the reason that they're doing that, of course, is the assumption is that your 2020 revenue was less than your 2019 revenue. If you're just going to compare 21 to 20, presumably there's not going to be many people who are applicable. You look at, or eligible. You look at 21 compared to 19, that's kind of your baseline for the last year, the last full year that we had that was pandemic free. So 21, make sure you're comparing to 2019. Only has to be a 20% reduction in revenue. So gross receipts, if they're 80% or less than the 2019 quarter, you're eligible. Now, there is potential for you can meet the first quarter 21 if the fourth quarter 20 passes that test compared to 2019. So, so you can kind of get grandfathered into the first quarter of 21, even if you don't meet that threshold. So, again, another important thing to note there. Another change, the eligible wages or the FTE threshold had been 100. It is now 500. So a lot more companies are going to be brought into this potentially. And it looks like we're still talking about FTE numbers in 2019, not what they were when you were applying. So if you're saying, well, I had 800 employees in 2019 and I have 200 now, I think we're still looking back at 2019 as the base. But again, any wage period paid between the first 6 months of the year in eligible quarter, not paid with forgiven PPP funds. So if you're going to get PPP2 funds, the ERC might not be applicable for you, especially if you're going to use 24 weeks of PPP2 funds. That's going to take you through June 30th. You're not going to have a whole lot of opportunity here for employee retention credit, depending on how your split is between payroll and non-payroll costs. However, until you get your PPP2 funds, which at this point we don't know when applications are going to be accepted, but realistically, let's say it's January 20th or somewhere around there where you get your PPP2 funds, you could claim the ERC for the first 3 weeks of 2021, assuming you've met the required thresholds. So, so this could definitely be a big deal going forward. There is an aspect of the law that says you can ask for an advance on the credit. I have no idea what that's going to look like. I can't even hazard a guess what that's going to look like. So that one we're going to have to just wait to see what the clarifications or the application or the forms or whatever says about that, because I really can't even venture what that might look like. So now, if you're going to file your 941, you determine, so I'm going to kind of go back into 2020 here a little bit, but it's also going to in fact impact 2021. If you're going, since you claim these on the 941, an important thing to know is that you make 941 deposits either with every pay or twice a month or every month, or if you're smaller, every quarter. So you make your 941 deposits, which is the federal and Social Security and Medicare withholding, and then the employer's share of Social Security and Medicare as well. You make those deposits on a consistent basis, and that's basically what the credit is going against. So when you file your 941 and you claim a credit, there's a couple of things that you can do. You can basically you compare the tax that you should have compared to the tax that you paid in. So what you could do is you could start reducing the 941 deposits that you make. Similar to on your personal tax return, if you know you're going to have a certain amount of tax due and you have a lot of withholdings and you say, well, I got a big refund at the end of the year, I should minimize my withholdings during the year so that I have that money during the year and not waiting until April. Same sort of thing applies here. You don't necessarily have to make all of your 941 deposits. You could look at maybe reducing those if you know you're going to get a credit. And the reason to potentially think about doing that is because if you don't do that and you have a big credit at the end, the only two ways to get it back are to carry it forward. And if you carry it forward, you're going to be stuck in the same position. You either have to reduce your deposits or you have a credit at the end. Or you can ask for a refund. And the asking for a refund isn't problematic at all, other than the fact that the IRS is dreadfully slow at the moment. And maybe you're saying to yourself, at the moment, they're always dreadfully slow, and that would be a fair comment. But they are really, really slow right now. I had a client apply in the second quarter for the employee retention credit, and it wasn't tons of dollars. I mean, it was significant to them, but it wasn't, it was less than six figures. And they got that check in early December. So, that's a 5-month window there. And now we're going into a period where the IRS is going to be opening up their filing period. So it's going to get slower. So if you're asking for a refund, expect it to be 5, 6, 7 months until you actually get that refund. If that's fine for you, that's great, but you ought to have that expectation. If you need that money sooner, if you need the cash flow impact of this credit sooner, that's when you should look at modifying what you're doing in terms of your 941 deposits. So if you need help walking through that, we'll be glad to discuss that with you. Depending on your payroll provider, that may be easier or harder to do. So that may not just be, it could give you some cash up front, be the most beneficial from a cash flow standpoint, but might be the hardest to actually implement. So talk with us about it. We'll be glad to give you some feedback on it. That's ERC in a nutshell, a pretty big nutshell. If you have questions, I can't say this enough, please ask us. Ben and my contact information will be available at the end of the webinar here, but also, whoever handles your account at Walls Group will be glad to answer your questions. If they don't know it, they can pass it up to me or Ben or someone, a payroll specialist or something like that. But we want to help you. We understand that there's complexity here. We also understand that there's uncertainty. We want you to be able to take advantage of these credits that are available to you, especially because we know that many of you are still suffering from the effects of decreased revenue or other business ramifications from the pandemic. So we want to help you. Feel free to reach out as you have questions. So with that, I'm going to turn it back over to Ben here for the last few minutes, and then we'll do a little bit of Q&A.
Thank you, Dan. Appreciate it. There have been some questions coming through, and I've been trying to answer as many of them as I can. Some good questions. Appreciate the ones that have been submitted. Let us know if the answers don't make sense. And we'll try to answer maybe a couple here verbally as well. So just a few cleanup items at the end, just items that exist, so we don't want to ignore them, but less substantive than some of the other things we covered. The first is, I believe it was back in August, there was put into place where your employees, if you allow them, had the opportunity to defer payroll taxes that were incurred in 2020 and pay them back between January and April of 2021. That has been extended to December 31, 2021. So if you're a business that's allowing your employees to take advantage of this program, that's been the time period for it to be paid back has been extended. At the beginning, there was discussions as to the deferral potentially being forgiven at some point in time. We haven't seen anything along those lines, so it looks like it is still a deferral. An EIDL advance, that was something that was available to select businesses with the CARES Act. If you received an advance, it would have been a number to the thousands between 0 and 10,000. At this stage, if you received less than $10,000, you would potentially have more available to you. What we're not certain on is if you received an initial $10,000 advance, if you are eligible for an additional $10,000 advance. We believe that the answer is that you're not, that they're just saying, hey, if you didn't get the full $10,000, you can get up to $10,000 now, but we'll let you know if that changes. Another item is that if you would be interested in an EID loan, those are still available through the SBA. Those aren't forgivable loans. Those still need to be paid back, but they have reasonable interest rates at a 30-year term. So they're favorable for this time. And it's not that EID loans are COVID-19 specific. They are eligible in the events of disasters. But COVID-19 has been declared one of those eligible uses, and that has been extended. So those are available to you. As it relates to the EIDL advances, if you received one of those with the CARES Act or and roundabouts the time of your PPP-1, one of the things that had been initially in place, and this was very much counterintuitive, so I acknowledge that before I say it, but if you received the advance, that advance reduced the amount of forgiveness you could receive on your PPP loan. So let's say you had a $100,000 PPP loan, you were able to file for full forgiveness. So your forgiveness application showed $100,000 of full forgiveness. Your bank, if you got a $10,000 EIDL advance, your bank would have only received $90,000 from the SBA, leaving you with a $10,000 PPP loan, which doesn't make sense since the EIDL advance was kind of presented as free money for your PPP to be reduced. And it seems like at this stage, they're trying to fix that. And they have said that neither the PPP-1 nor PPP-2 will be reduced by any EIDL advances received. So that kind of hiccup, I guess maybe it would be, seems to have gone away. Still to be determined how this will be retroactively applied. If you are somebody who already had in that scenario where you had a $100,000 loan and you only got $90,000 in forgiveness because of your advance, the bill seems to say that that will get fixed, that remaining $10,000 balance will be cleared up, but it doesn't necessarily indicate how the SBA is going to work with the various banks to get that cleaned up. So I don't know the how, but it seems like it should go away. As it kind of in closing on this topic, before just one quick last slide, things to be doing now. As you are able, accumulate 2019 and 2020 quarterly revenue information to determine if you meet at least a 25% revenue reduction breakdown. Keeping in mind, 25% gets you eligible for PPP-2, 50% gets you eligible for ERC. So if you are roundabouts those numbers, if you are clearly over 25 or clearly over 50, it's easy. Where things get tricky is if you're at 49% or 24%, that's where the devil will be in the details. And we'll want to dig into that, but start gathering that information, become familiar with that information and what's there. Also begin accumulating 2019 and 2020 payroll information, payroll being gross payroll, group health insurance, retirement, employer, state and local taxes, group life, disability, vision, and dental. Just start gathering that information if you can, if you think you're going to be eligible. I quickly reading through the IFRs that came out last night, I did not see anything that says, hey, this is when the bank portals will be open, but presumably the amount of time between now and then could be fairly short. And I think that there's benefits to trying to have some ducks in a row here sooner rather than later. So that would be a recommendation if you feel like you're eligible for some of the programs we've had here. The last thing we wanted to mention before we get into questions is just the reality that within the CAA, there was significant tax extensions, tax law put into place. We're not necessarily covering that here. You could say that the ERC is tax related and it's actually in the tax section of the CAA. But there is significantly more. We're not covering that here, but we will be covering it in the future. There's a reality to where that is good information, but whatever pieces of it applied to 2020, we've passed the end of the year for most of those. And the time sensitivity to that information is not necessarily as pressing as what we've tried to bring here. So with that, I don't know, Dan, if you want to unmute yourself, if you have some thoughts in terms of questions that it might be good to cover here. Here's our contact information. Maybe we leave this up just while we're talking.
Yeah, so there's a couple questions that we've gotten here that we've we've sent answers to the person who asked them, but a couple questions on like under PPP1, the expanded uses in terms of operational expenditures. There's two questions about that. One would be about accounting fees, and another would be about credit card processing fees. So Ben, you had commented, you had responded to those answers. You want to give an answer to that to the group here?
No, that's fair. Essentially, operating expenses as we look at potentially new eligible expenses for forgiveness. Operating expenses sounds very broad, and I think it is broad, but it's broad somewhat in a narrow sense. It seems like it's applying to your software costs, your business software, if you have HR software, if you have inventory tracking software, if you have accounting software, under that umbrella, it's pretty broad in what it covers, but it seems like it's looking towards those software and computing costs when you kind of get into what is it actually saying. So maybe there's some more detail coming out. I did look up real quick in the IFRs that came out yesterday to see if they expand on what's in the bill, and it doesn't appear like they do.
So there was a question then about whether the quarters that we were talking about are calendar quarters versus a rolling 13-week period, and considering that most payroll returns are based on the actual calendar quarter, I think that's what we're going to be looking at here. So when we talk about quarters, we're talking about, January, February, March is quarter one, April, May, June is quarter two, July, August, September is quarter three, October, November, December is quarter four. Just looking through a couple other questions here.
I'll be honest, there's some really good questions here that if you haven't gotten an answer yet, the answer may be that we need to do a little digging. There's some good questions that aren't as easy. It's not that they're long, but they're well thought out and interesting thoughts.
So there's a question that came through about, for the employee retention credit, is this gross wages? Is it based on is it cash basis? Does it include accrued wages, anything like that? And here, we're talking about wages paid for the employee retention credit. So when you're talking about calculating the credit, it's going to be based on what was actually paid. The wages that you'd be reporting on your 941, which is when they were paid. So an accrual or anything like that would not. That's a good question, but accruing a bonus or anything like that gets someone over a threshold of $10,000 of non-PPP related wages would not count. Has to be paid out. So whatever quarter it was paid in is when is what you're going to take the credit on. There's also a question about gross receipts, and that's important to note there about that being a tax method. So when we talk about gross receipt reduction, there was some clarification came out there about it's what your tax method is. So if your accrual method, it's based on your accrual basis income. If your cash basis, then it's based on your cash basis income. There has been some discussion about whether or not a method change and how that would play into things, and that could definitely have some repercussions. That's a little deep to get into all the intricacies of that today, but there is some potential there that a change in accounting method, if you're eligible for one, could get you to a position where you could have that, you could meet that reduction that you might not otherwise meet.
Interestingly, along those lines, the IFR last night does point towards, if you're struggling to come up with substantiation for how you're eligible, comparing your 2019 to your 2020 tax return after the fact is listed as one of the options. So it does lend somewhat to that thought.
Right. So if that's a situation that you might be in, that's probably better to have a discussion with someone on your account. But that is potentially an option. So let's see what other open questions we have here. So there's a question about an LLC that exists to own property. Can that LLC claim a loss if the tenant was unable to pay rent? I'm assuming that you're meaning a reduction in revenue. I think the important part there is, do you have wages? If it's just an LLC that's holding property, most times you're not going to have wages, so you're not going to have anything to have a basis for applying for the PPP. You're not going to have anything to be a basis for applying for the employee retention credit. So if you're solely in kind of a landlord-tenant relationship, theoretically, yes, anything that you have, that if your tenant can't pay you, that would be a reduction in gross receipts I think would be eligible, but absent the payroll, which is the basis for driving these credits, and the PPP, that could limit your eligibility there. Another good question is, what happens if we have two components of our business and one was shut down and one was not shut down? I think that's a really, really, really good question. I don't know that there's a specific clear answer. I'll give you mine in terms of like ERC, where being subject to a shutdown order. If you've got two segments of your business, I do not think you can look at a gross receipt and say, well, one segment of our business was down 70%, the other segment was down 10%, so I'm going to claim the ERC on the segment that was down 70%. That's not going to work. But in terms of being subject to a shutdown order, my thought would be that if you've got employees who are affected by a shutdown order for one segment of your business, that's where the full or partial shutdown language comes into play. I would think that that's probably a legitimate claim for an employee retention credit. If you've got two segments of your business, one of which was closed and one of which was open, the shutdown one would be eligible. The people who work there would be eligible. It's probably going to be easier if you have people if you've got wages that are split between those two things. That could be a little harder, but even so, there still could be some potential there. One other comment that I got that I want to clarify, when I had said about giving some consideration to modifying your 941 deposits, please don't just stop making your 941 deposits, because there is underpayment penalties. You should be only doing this if you know that you're going to get, hey, I think we're going to get a $300,000 credit here. My 941 deposits, I've got 5 of those left, and they're averaging $40,000 per deposit. Maybe I should hold off on making some of those. You do not want to just hold off and then have pay everything in at the end of the quarter, because there is going to be underpayment penalties potentially assessed there. So you don't want to be doing that. But if you're comfortable with what the credit can potentially be, then that can lead you to changing what your 941 deposit is. So don't just carte blanche stop making 941 deposits. So that about takes us to the end of our 90 minutes here. If there's a question that you put on the Q&A, we'll cut and paste those so that we have them retained. And if your name is attached to the question, some of them came in anonymously, but if your name's attached to the question and we haven't gotten it back to you, we will email that to you. But I want to thank all of you for taking time out here at the beginning of the year to take an hour and a half out of your time to learn more about this. And like I've said, we're here to help you. We want to assist you through this process. It may be a little cumbersome. It may be a little timely, or it may not be time. I mean, our advice to you will be timely, but the benefit of this, we may have to wait till we get more clarity, especially on the employee retention credit. But we want to be able to help you plan and help you put together a game plan. So again, thank you for your time and your attention. We appreciate your attendance here, and I wish everyone a good day.